Let me ask you something. What if the main tool we use to measure our economy, the very compass that guides these huge trillion-dollar decisions, has been broken for decades? Well, today, we're diving into this incredible story about how a simple counting error might have misled an entire generation of economists. It really makes you wonder what else we might be getting wrong.
Think about it like this. You're the captain of a giant ship, trying to get through a storm, but your compass is busted. You think you're heading north, but really, you're drifting straight towards the rocks. That's pretty much the question this research asks about the Federal Reserve's handling of the economy, especially during the really critical period of the 1980s.
And this chart right here, it just perfectly lays out the mystery. See these two lines? They're both supposed to be measuring the exact same thing, the money supply. And for years, they moved together, totally in sync. But then, right around 1980, they just split. One line is basically screaming, inflation ahead, while the other is whispering, everything's fine. Now, if you're the one in charge, which one do you listen to?
To really get why this happened, we've got to rewind the clock a bit and look at the moment the Fed's compass first started to spin out of control.
So back in the late 1970s, economists were feeling pretty confident. They thought they had cracked a major code. The big idea was, if you can control how much money is out there, you can control inflation. The link between the two seemed rock solid, predictable, almost like a law of physics. This was the golden age for an idea called monetarism.
But here's the twist. The second the Federal Reserve decided to actually use this new, supposedly perfect map to steer the economic ship, things got weird. All of a sudden, the economy started doing things that nobody saw coming.
And you can see on this timeline just how fast it all fell apart. Late 70s, the theory looks great. But in the early 80s, the moment the Fed starts using this M1 measure to make policy, the whole relationship just shatters. The old models, useless. Inflation predictions were all over the place. In just a few years, one of the biggest ideas in economics was basically in ruins.
So what on earth happened? Well, the go-to explanation, the story everyone told, was financial innovation. New types of bank accounts, new financial products. The idea was that all this new stuff had completely changed how money worked, so the old rules just didn't apply anymore. It was a complex problem for what seemed like a newly complex world.
But here's where this research drops a bombshell. What if the economy hadn't actually become this impossibly complex thing? What if the problem wasn't the world itself, but the ruler that economists were using to measure it?
And that gets us to the real heart of the matter. It all boils down to a super basic question. How do you actually count money? Okay, so the standard method, the one the Fed was using, is called simple sum. And it's exactly what it sounds like. You just take all the cash, all the money in checking accounts, and you add it all up. A dollar is a dollar is a dollar. It assumes every single form of money is perfectly interchangeable.
But there's another way to do it, called division. And this method is a lot smarter. It gets that not all money is created equal. A dollar bill in your wallet is way easier to spend. It's more money-like than a dollar you've got stashed in a savings account. So division actually weighs different kinds of money based on how easily you can use them to buy stuff.
This little analogy makes the difference totally clear. Simple sum is like looking at a fruit basket and saying 1 grape plus 1 watermelon equals 2 fruits. Technically true, but kind of useless, right? Division is way smarter. It knows that a watermelon has a lot more fruitness than a single grape, and it counts it that way. That's the difference. Simple sum treats cash in your pocket the same as money in a savings account. Division knows better.
So the big question is, does this different way of counting actually matter? Well, this is where the story gets really good. It turns out that this one little change can turn what we thought were solid economic facts into complete myths.
Okay, let's take a famous study, one that even helped win a Nobel Prize. It seems like common sense, right? When the economy is booming, the amount of money flowing around should grow too. Economists call this being pro-cyclical. But this landmark study, using the standard simple sum data, came to a totally shocking conclusion. They said it was a myth.
But just look what happens when you swap out the measurement tool. The original study, using that simple sum data, concludes, nope, money isn't pro-cyclical. But when you rerun the exact same analysis with the better division measure, the conclusion does a complete 180. It says, yes, money is strongly pro-cyclical. The myth wasn't the relationship itself. The myth was created by the bad measurement.
All right, here's another one. A really well-known study found that monetary policy was kind of like pushing on a string. The idea was that if you cut the money supply, you could definitely slow the economy down. But if you tried to increase it to speed things up,
It didn't really do much. The effects were what they called asymmetric.
And you guessed it. That conclusion completely vaporizes when you switch to division. The original data shows those asymmetric effects, the whole pushing on a string idea, but the division data shows the effects are actually symmetric. Pushing and pulling on that string have pretty much the same impact. Another core economic belief just totally flipped on its head by a simple counting correction.
Now, this is where it gets genuinely scary if you're a policymaker. Take a look at the data around the 1990 recession. The standard measure, that's the solid line, is telling the Fed one story. But the divisia measure, the dashed line, is telling the exact opposite story. You have one compass pointing north and the other one pointing south. Making the wrong call here could be the difference between a mild downturn and a really deep recession.
So let's pull all of this together and talk about the big picture here, and why getting the measurement right is so incredibly important.
This, right here, is the stunning bottom line of the paper. The author went back and replicated 5 super influential studies that had challenged all the old ideas about money. And in 4 out of those 5, just by swapping out the flawed simple sum measure for the better divisa one, the original conclusion was completely reversed. So the takeaways here are huge. First, how we measure stuff isn't just some boring technical detail. It can literally change our entire understanding of how the world works. Second, if our leaders are using bad data, they can make bad decisions that affect all of us, our jobs, inflation, everything. And finally, it's this amazing reminder that sometimes the biggest breakthroughs aren't about some complex new theory, but just about getting the simple things right. And that leaves us with one final, pretty unsettling thought. Decades after this research came out, the most common numbers for the money supply that you hear about in the news are still the simple sum ones, which forces us right back to our very first question. Are we still trying to navigate our economic future with a broken compass?